Great. So today we are going to start with introduction to Forex, and you realize you're actually like building more on what we did yesterday. All right. There's so much repetition of what we studied yesterday on the terminologies. So like we're just building on that to ensure we get the right basics as we start and we start getting deeper into Forex. And we started defining Forex trading. And we said Forex stands for foreign exchange, which is exchanging one currency for another. So we said in Forex, we trade with money. We buy money with money, okay? So the main assets we do, it is buying currencies with other currencies. And it is the largest financial market in the world. The largest financial market in the world. And we said it's both in volume of participants and the amount of money exchanged, okay? And we say it over $5.5 trillion is exchanged in Forex market every single day through buying and selling. And that exceeds the current volume in Wall Street or New York Exchange, which is about 74 billion or slightly higher than that from the last time I picked the figures. So when trading Forex, you buy and sell currency, and that's what we said. So assuming you're in America, visiting Japan, you have traded the dollar for yen. Also, again, we used a local scenario where in Kenya, we import cars from Japan. So for us to get the car come to Kenya, somebody has to send Japanese yen to Japan. You cannot send Kenya shillings. Either Japanese yen or a globally recognized currency like dollars. Then they're able to send you the car. So already foreign exchanges is taking place. So it's always happening, you know, as you travel, when guys travel to Turkey to buy their clothes for selling, their handbags, already foreign exchange is taking place, okay? So it's done in a normal business as well as a full-time business in exchanging currencies, in buying and selling currencies. And you say buying a currency is like buying a share in a country. The price of the currency is a direct reflection of what the markets think of the future health of that economy. So buying a currency is like buying a share in a country. If you recall yesterday, we said there are economic reports which are released every week concerning the economies of the major countries, especially. Like when you look at America, every week when you look at the Forex factory calendar, you'll see a schedule of the reports scheduled to be released. Could be inflation, employment, unemployment, change in employment, change in unemployment. All those reports speak a lot about the health of the economy of United States or of America. So what you're saying, if the health of the economy is so good, if you look at those reports and we see this country is doing so well economically, every investor will want to buy a share in that country. And we get a share of the country by buying the currency of that country. If you can just bring it back at home, let's say we look at the companies in Kenya. Again, we'll use Safaricom, okay? So when you look at the earnings for Safaricom, the profits, okay, the profit after tax, and all the other parameters of their performance. And we see this company is doing so well. Everybody wants to buy share in that company, okay? And because of that, the shares appreciate. That's the same way it works with our country and its currency. So when the economy of our country is doing so well, based on the reports which are circulated every now and then, every investor, because the country is doing so well economically, every investor wants to have a share in the economy of that country, and we do that by buying the currency of that country. And because of that, the demand for the currency will go up, and because of that, it also goes up in value, all right? So buying a currency is like buying a share in a country, just the way it is like buying a share in a company which is doing so well, all right? Okay. In the Forex market, it has sessions. Basically, we say it operates in 24 hours. It's a 24-hour market. That's the Forex market. So one will wonder, do guys just trade from, 24 hours non-stop? Where do they sleep? What happens? So what happens, the market has various sessions, all right? But there are three major sessions. They are called major because during those sessions, there are so many participants and also the volume exchanged is high. So in those are the most active sessions where the currencies move so much by many pips because of many participants and big volumes of money is being exchanged. So we have the Asian session, we also have the London session and the New York session. And they also occur in the same order, right? The first day in the morning, we start with the Asian session, which starts around 1 a.m. Kenyan time. I think I picked the time somewhere just for you, okay? Asia starts at 3 a.m. in the morning, Kenyan time. Now I'm using Kenyan time. Asia market opens 3 a.m. in the morning, and it will close around 12 noon. Yes, around 12 noon Kenyan time. Then at around 11 a.m. Kenyan time, London session will open. So between 11 a.m. and 12 or thereabouts, we have those two sessions overlapping. And we said when you have two major sessions overlapping, the volumes are also high and the currencies are likely to move more or faster because there are many participants and big volumes are being exchanged. So there is that period of the time when Asian session overlaps the London session. Okay, so London will open at 11 a.m. Kenyan time and go all the way to 8 p.m. Kenyan time. That is the London session. Okay, then at around 4 p.m. Kenyan time, New York session opens. So between 4 p.m. and 8 p.m. Kenyan time, we have the London session and the New York session overlapping. Again, another opportunity for big volumes moving because of also having many participants and also increased liquidity and volatility, which also makes the market to move a little bit faster. All right. Then New York session closes at around 1 p.m. I was to actually confirm. Just if you give me 1 second, I'll just tell you right now what time it closes Kenyan time. All that information, you don't even have to cram. When you open the Forex Factory calendar and you scroll down, at the very bottom there's somewhere written sessions. You'll see Sydney, Tokyo, London, and then New York. Okay? So New York will actually close at 1 a.m. Kenyan time. 1 a.m. Kenyan time. All right? So again, we are seeing that overlap between 4 p.m. to 8 p.m. Kenyan time. London session and New York session are overlapping. Then at 8 p.m., London market will close, and then the New York session will continue until 1 a.m. So those three are the major sessions, but we have some two small markets. That's the Sydney session and the Frankfurt sessions. Sydney opens at 1 a.m. Kenyan time. Okay, so you can see as New York closes at 1 a.m., Sydney opens right away, and it continues. And the cycle continues day by day from Monday to Friday. Okay, because although it operates 24 hours, it closes on Friday at 1 a.m. So when the New York session closes on Friday at 1 a.m., now there is no business until Sunday 1 a.m. when the Sydney session starts. Are we together? So each session hands over the market to the next session. And because it is global and it's online, it just builds automatically. Everything just continues flowing and flowing. But the business is most active during the Asian session, London session, and the New York session. I prefer to start trading during the London session when it opens. That's at 11 a.m. Kenyan time. Because when Asia market is closing, there is not so much business. During its last hours, it's a little bit very calm. So when it is calm, it takes you time to give you a signal. You do analysis, you have to wait for long to get any indication of if you can be able to enter. All right. So when I open another tab, my system hangs. Just because I opened the Forex Factory, it has hung. Hope you guys are still there. Let me just say something. Can you all hear me? It's actually hanging, so I'll be... Okay, Ricky, you're online. Thank you. Thank you for joining us. Just give me 1 second. I have to do, but you'll still be okay. You remain online. I need to reduce something for me to be able, because it's hanging because of opening the Forex factor. Great. We should be okay now. Yeah? So we proceed. But in case of anything, you can always interrupt me and ask any question. That is very much allowed. So we say there are three major sessions, and they are major because we have many participants and a lot of volume of money exchanging hands. So they are the most active. But the most active period, it's actually between 4 p.m. Kenyan time and 8 p.m. Kenyan time, when the London session and the New York session is overlapping. Also, London market is pretty busy. It really moves when it comes to currencies, okay? It also moves a lot. It's also pretty busy, just the London session itself. So personally, I like to start trading from 11 a.m. Kenyan time, which is 10 a.m. my time here, right? But so based on all that, you can always try to check when is the best time for you to trade based on your work schedule and other activities around you, okay? So we say there's also a very small session, not so busy, called the Sydney session, which starts at 1 a.m. That one is really a very tricky session. I've ever tried to trade it. At that moment, because there are very few participants, but it's a lot of money exchange, but the volatility is extremely high. The spread is also very high for some of those currencies. So the Sydney market from 1 a.m. is usually very tricky before the Asian session joins at 3 a.m. You know, those days when I began Forex, yeah, it was my blood. There's a day I did 48 hours without sleeping. I just loved it. I could just trade and trade, try to protect capital, doing everything, you know, and also try to find out where do I belong, which is the best time for me to trade. But I realized trading at 1 a.m. is extremely risky. The market it moves so fast because of high volatility, but also the spread is so high. So if that session finds you in the market, that is fine. But to enter around that time is so tricky because of the spread. You find your entries always filled at a very bad price because of what we call slippage. Slippage. And slippage happens when you open your market execution. We saw what that is, and I will also illustrate to you today. When you open your screen, you see the price there. USD selling at 1.2000. But the moment you click sell, you are filled at 1.2020. So you lose already you start at a negative 20 points. Okay? So that's what slippage can lead you to. You see the price displayed there, which is 1.2000 for USD, but the moment you click sell, you're filled at extremely poor price. You already start from negative 20 points. And that happens when the market is very volatile, because we say at that moment, the sellers will move backwards, pull down their prices, they give a very poor bid price, and the buyers also push backwards. So there's a very big gap between them. All right. So the moment you click yours, it has to walk a long distance to be filled. In the process, you lose. Like there's a gapping on your side. You remember what we discussed about gapping. Okay. So the 1 a.m. is a very tricky market. I've tried and I've realized it's really difficult to trade unless you're very good at it. Anyway, you can always try. We are all different. But it's quite volatile and the spreads are huge for all the brokers during that because of volatility. Okay. So if we said City becomes from 1 a.m., then Asia peaks over 3 a.m. continues, then before it closes, London session joins in, it continues. Before it closes, New York session joins in and then it continues. I'm sure one will wonder, we always hear the market closed at this price. So you ask yourself, if it's operating like this, so what time is the closing price? When you say that today the market closed at this price, how do we determine the closing price? So how it has been designed globally, the market picks the closing price for New York session as the closing price for the day. All right? So when the New York session closes at 1 a.m., where each price closes at, that's the closing price for that particular day. Like today is 12th of February. At exactly 1 a.m. Kenyan time, the New York session will close. So all the price at that moment, all the price for all the currencies, when it is closing, that is the closing price for all those currencies for today, which is adopted by all the other markets globally. That's how we designed it to operate. So the opening price becomes the price which the Sydney market is going to open at 1 a.m. as they pick over from the New York session. All right? And unless there is gapping, we see what gapping is. Always the closing price for today automatically becomes the opening price for the following day. I'll also demonstrate to you today how that happens. So the closing price for end of day today will become the opening price for starting of day tomorrow. All right? So we move on to the next slide, which is about the currencies. So we say there are 8 major currencies traded in the Forex market. Again, we say they are major because they are the most widely traded ones, okay? And you're better off using the ones which are widely traded because it means they have more volumes, both in the amount of money exchanged as well as the number of participants. So if the volume is so high in that particular currency, it means then they also move more. So they move by many pips in a day. They also move a little bit faster. So it means when you do your analysis, you don't have to wait for the whole day. For your area of interest, for the price to reach your area of interest. And we said an area of interest is where after you've done your analysis and you say, I'm only comfortable to enter the market at this particular price. So you're waiting for the market to reach where you've already identified. So that's an area of interest. So if the market is moving so fast and it's so busy and the currency of picked, it's a highly traded or widely traded currency. It means the market likes to move a little bit faster. Maybe in an hour's time, your area of interest will be reached, then your order can be filled. So that's why we mostly focus on the 8 major traded currencies, right? A currency symbols always have the 3 letters in them, with the first 2 letters representing the country and the last letter representing the currency. The first 2 letters represent the country and the last letter representing the currency. So that explains to us how these currencies are named, all right? Like US dollar, we talk of United States dollar, all right? We have a list there of the symbol of that particular currency, the country of origin or where it is used or where it has been adopted, and then the nickname. Again, we say these nicknames, it's because of, we'll read some analysis and you realize some analysts will always call the currency by their nicknames. So it just enables us or helps us to flow when we read other people's analysis. When you hear somebody say the fiber today is bullish, you're not like, which currency is called fiber? That's just nickname of the euro, all right? So just to go through that list, we have the US dollar from the United States, nickname called the greenback. Then we have the euro. Remember, euro is adopted by the 27 countries in Europe. Okay, all the countries within the EU, they use the euro. Talk of the Italy, German, who else? All those countries. And why you need to know that, it's because anytime there's something happening in any of those countries, like in Europe, in France, all those guys who use euro, okay? Anytime there is any issue in that country, it will affect how the euro moves. So I can also actually, I will share with you later the list of all the countries which use euro. There are 27 of them. I have a list somewhere. I will send you. So that you know if there's something happening in Italy, you know it's going to affect the euro. Anything happening in Germany is going to affect the euro. You need to know which countries will affect a particular currency or will make it to move either to increase in value or decrease in value. Okay. Then we have the GBP pound for Great Britain, nicknamed as Cable. CHF francs for Switzerland, nicknamed as Swissie. Canadian dollar, CAD dollar, Canada, loonie. Japanese yen for Japan, they call it yen in short. So then AUD dollar, or the Australian dollar for Australia, they call it Aussie. Then the New Zealand dollar, which is for New Zealand, they call it Kiwi. Well, we don't have to spend much on that. That is very straightforward. So we move on to the next. So remember, we said currencies are always traded in pairs. Yeah, and we use the example of USD CAD, right? So if you pick USD CAD, when you buy USD CAD, in that transaction, you're actually buying the USD and selling the CAD, right? So anytime you're always buying the other one, but automatically or in default, you're selling the other one. They are always in pairs. So when you say one currency is increasing in value, you need to ask yourself, it's increasing in value compared to which other one, or rather based on which one, all right? And we said, like if we have the Euro USD, if the Euro, sorry, in the Euro USD, the Euro is the base currency. If you remember what we said, the first one, in that pair, the first one is the base currency, the second is the quoted currency, okay? So like in Euro USD, the Euro is the base currency and the dollar is the quoted currency. It's like we are quoting Euro in terms of the dollars. To get 1 euro, you need that amount of dollars, all right? So in the pair EUR-USD, if the euro is rising in value, it is rising in value as compared to the dollar, which would make Euro-USD to go up. So if euro is appreciating, it means it's appreciating compared to the USD, and so that pair will go up. Or rather, because euro is increasing in value, more buyers or bulls will buy more of Euro USD, and then the pair will go up. Why is it going up? It's going up because as euro increases in value, you need more dollars to buy 1 unit of euro. As euro increases in value, you need more dollars to buy 1 euro. So because it is increasing in value, so the higher it appreciates, the more the amount of dollars you need. So because of that, it starts moving up. So the more buyers buy it, or the more the demand goes up, the more it appreciates, and the more the Euro USD pair goes up in your price chart. Okay, hope you get it. So if the euro is losing value, Euro USD will go down. If euro is weakening, that pair, Euro USD in our price chart, it will start moving down, or rather will adopt the bearish movement because it is losing in value. No one wants to buy it. People are actually disposing it, so they are selling it. And so when there is more selling, it means there are more buyers and it will move down. The sellers move the market down. Because it is decreasing in value, it means USD is also strengthening against the euro. So we need less USD to buy 1 unit of euro, and the whole pair in our chart will be moving down to adopt a bearish movement, right? And if the pair euro USD, if the dollar, which is the quoted currency or the quote currency, if it is rising in value, it is rising in value as compared to the euro, which would make Euro USD to go down. So if euro is strengthening, okay, it means you require less USD to buy 1 unit of euro. So it starts going down because the number of dollars you require to buy 1 unit of dollar, they are decreasing. So the whole pair goes down and we have a bearish movement of that pair. Okay, so they are always traded in pair. As one is increasing, it has to be increasing value against another one. So you are better off if you realize today the pound is weakening in value and the dollar is strengthening. That's the best pair to focus on, all right? Where there's like to be a bigger difference in their movement. So that will make that pair to move by many pips in a day. Okay, and now we go to leverage, and we said yesterday that leverage is borrowing money from the forex broker so that you can get an even bigger exposure to the market. We saw yesterday markets at forex, the way you trade it is actually done in lots, and one standard lot is equivalent to $100,000, which again is broken further to mini lots of $10,000 and micro lots of $1,000. But again, you said even given that kind of a scenario, small traders like me and you, we cannot be able to afford that, so we may not be able to participate in the market. So for the brokers to enable as many traders as possible to participate in the forex market, they give us loans, which is called a leverage. And this loan, they don't give you and put it in your account. They set up the system in such a way that anytime you trade, the system will incorporate the loan there and allow you to gain a bigger exposure in the market, to trade some bigger volumes of trades or of contracts, which without the leverage you would not be able to afford. And we saw an example like FXTM. Leverage is 1:500, which means for every dollar you deposit, they give you 500 times your amount to enable you to access the market. If you open it $100, multiply that by 500. So you have an exposure of $50,000 to be able to participate. But again, remember we said, leverage is a double-edged sword. You have to use it sparingly. Don't over-leverage your account. Otherwise, you'll get margin call, then eventually margin stop out. And you'll also see through all this through by demonstrating in our systems later. Then we talk about pips. I think pip, it was very clear yesterday. We discussed it further, and we said that pip is the 4th decimal point in the exchange rate. And we had an example of this USD CAD. If the price is 1.2000 and it moves by it moves from 1.2000 to 1.2001, it means it has moved by 1 pip. That movement in the 4th decimal point is what we call a pip. Okay. But some currencies, the decimal points are 2. Like USD JPY, all the Japanese pairs, they have 2 decimal points. So a pip is counted on the 2nd decimal point. And this one, you don't even have to cram or anything. It's always just for you to understand. In case you see such kind of scenarios to understand. Some have 2 decimal points, others have 4 decimal points. But when you open your platform, your MT4, you'll see all that in your chart. The amount of pips the market moves determines your profit or your loss. So although these currency movements may seem small, but due to leverage used in the forex market, small changes can result in large profits. And we saw that. And we said a pip is equivalent to plus or minus 10 for a contract of 1 standard lot. So if you buy 1 lot, it moves by 10 pips. That is, so if you buy 1 lot, it moves by maybe 1 pip, that is $1. If it moves by 10 pips, it is 10 times 10, because it is $10 per pip. It gives you $100, right? And we have an example here. Let's assume we buy GBP USD at the price of 1.5734. We've done our analysis and we feel it's time to buy this pair. And then the market moves up and it reaches 1.5818. Right? Then we exit the market, or rather we close our trade. So how many pips did the market move? So we'll take the price at which we exited, that is 1.5818, take away your buying price. It's just a normal way, like if you buy a goat today, 7,000 shillings, and you sell tomorrow at 8,000, what's your profit? It's the selling price minus the buying price. So the same case here. But in this case, it will give us the pips. Now then, which when you multiply by the amount for a pip, it gives you your amount of profit. So if it moves, so this one moves by 84 pips. So if you had bought one standard lot of GBP USD, then you would make $840. That is 84 times 10 in that particular trade. Okay? But again, you say you can always buy in terms of a mini lot or a micro lot. Then we have types of market analysis. And we said for you to decide whether to buy or to sell, you have to carry out proper market analysis. We do either technical analysis or fundamental analysis, right? And we say technical analysis, you focus on the chart itself. What is the chart telling you? What is the price movement telling you? Okay, then when you do your analysis, you decide at what point am I going to buy, or am I going to sell, or am I going to stay away from the market? All right, so that's the technical analysis. You can see Luther, you joined us, eh? Karibu. So how does the market work? Remember we said we have the buyers and the sellers. The buyers are the bulls, the sellers are the bears. So the market is usually a fight between the bulls and the bears. Whoever is stronger takes the day. If the bulls are stronger, they'll move the market up, and it's a bullish market. If the bears or the sellers are stronger, they're gonna move the market down, and it's a bearish market. So the Forex market is a free market, and it's not centrally governed or owned by anyone. It's it regulates itself. No one can say, no, today we are going to do this that way. No. Whatever traders do, they decide how the market is going to move. No one governs it. No one really controls it. It is a free market. You can come in anytime, you leave anytime, and there are no rules. Okay? You set your own rules, how you're going to trade. Rules you need to ensure they favor your profitability. So you go to market analysis, just what we had discussed earlier. So in market analysis, we said for us, we'll focus more on technical analysis. But we'll also realize you cannot just say you're a technical analyst and you ignore the fundamentals, because they are very much related. You have to understand which reports are being released. Like today around, I think 7:45 or something like that, 8:45 Kenyan time, the chair for the Central Bank of America, that's the Federal Reserve Bank of America, will be giving a speech. So if you check your Forex factory, you'll see that it's highlighted in red, because that is hot news. How the tone of that speech, remember yesterday we discussed about the dovish tone and hawkish tone. So during his speech, if he sounds in a way, if his tone will be dovish, dollar is likely to go down. If it is hawkish, it's likely to go up. But depending on the weight of his speech, it can either maintain that move for a long time, or it can just be like a swing for a few minutes, then it resumes its earlier movement. So it's always good to know what is expected, which reports are we expecting, who is likely to speak today, either for you to stay away from the market or for you to ensure just before the speech, if you have any trade running, if you're in profit, lock your profit, so that in case the market moves against you because of that speech, you don't lose what you've already earned, all right? And we do our technical analysis using what we call Japanese candlesticks. And these Japanese candlesticks, they have a history, which we really don't have to go into details with it. But let's see how it works with Japanese candlesticks. So I will close this presentation and load another one just in a second. And again, we said, in case you have any question, you don't have to wait until the end. You can always interrupt me and you ask your question. So we said we do our analysis using the Japanese candlestick. So in order to determine when to buy and when to sell, a trader has to do a detailed analysis of the price chart. A trader needs to make informed decision on when to buy, when to sell. So we carry out that using the Japanese candlestick. And also in your analysis, as we discussed yesterday, you also decide where to place your stop loss and your take profit. Candlesticks are graphical presentations of market price movements within a specified time period. Candlesticks are graphical presentations of market price movements within a specified time period. The time period is very important. Many times in the Forex market, we call the time frame. Somebody will ask you, which time frame do you trade? Okay, it can be 15 minutes time frame, 1 hour time frame, or 4-hour time frame. It means which candlesticks do you look at when you're doing your analysis. So a candlestick may represent price movement that occurred in the 1 minute, 5 minutes, or 15 minutes, 30 minutes, 1 hour, and 4 hours. So it means if you go to 1 hour candlestick, it means, 1 minute. Let's start with 1 minute. If you go to 1 minute candlestick time frame, every 1 minute a candle is starting. When that minute ends, it closes and another one starts. So all those candles represent how the price moved within 1 minute. Okay? So for 1 minute candlestick, it will open with an opening price. The price moves whether they are bulls or the bears. It keep on fighting. And at the end of that 1 minute, irrespective of where the price is, whether it is on the bull side or the bear side, at the end of that one minute, the candle just closes and the price moves on to start a new candle. So that's a 1 minute candlestick. The same case with the 5 minutes. It means every 5 minutes a candle starts. Yeah, it starts right now. It runs at the end of 5 minutes. It doesn't matter where the price is. The candlestick will just close and the price moves to start a new candlestick. Yeah, that's why you're saying a candlestick is a graphical representation of market price movements within a specified time period. All right, but you're going to also look at details of how this all works so that you understand it better. So we have bullish candlesticks and bearish candlesticks. And a bullish candlestick represents market prices that are moving up. Remember we said bulls push the market up. So bullish candlestick represents market prices that are moving up. Just 1 second. Yes, I'll read this. So the closing price is higher than the opening price. So for bullish candlestick, the closing price will be above because it's bullish. When the market opened, the price started moving up. So it forms a bullish candlestick. So it closes above the opening price. Okay? And then the opening price would be the market price at the beginning of the 1 hour. Like when you look at this green candlestick here, you can see there is open. It means if it is 1 hour candlestick, at the beginning of the hour, the price was at this level where it's written open. That's why the candlestick opened. Then it tried to move down up to low. Low, it means is the lowest point the market moved during that 1 hour. Okay? So when it opened, the bears tried to push it down, but they were overwhelmed by the buyers. The buyers took control. They pushed it up to where you can see high. High means is the highest point the price reached during that 1 hour, if it's a 1 hour candlestick. If it is 1 minute, it also means it is the highest price the market reached during that 1 minute. So depending on the time frame you're using, that's the interpretation of that. So the high and the low are the highest and the lowest prices that were traded within that 1 hour respectively. And I just want to demonstrate something for you in a board. Just give me 1 second. I show you some. Oh, sorry. I went to the wrong place. I don't want to share screen. You can see that. So let's assume right now, let's say the hour just starts from here. Yeah. So when the hour is beginning, this is our open. This is where the price starts when that one. Oh, sorry. Just a second. So we can just draw a small line here. And you're saying when the hour, when this hour was starting, this is where the market started. It opened here. This is our open. So I just write it here. Our open. Let's assume it's our USD/CAD and it opened at 1 point, our common price, 2000. 2000. So we are saying when this 1 hour was starting, USD/CAD was at 1.2000. So in this hour, the candlestick, that should be our opening price. Open means the opening price of that candlestick. Okay. So when the market opens, the bears try to come in. They try to push the price down. They reach somewhere here. Okay, which is 1.1980. So the bears reach here, but again, there's so much struggle. The bulls come in and they return the market up. They take it up, up, up to around somewhere here, which is 1.2200. When they reach that level, the bears feel, no, we've got to fight. They push the market down again, and then when they are around here, that 1 hour lapses. The moment the 1 hour lapses, the candle has to close. Okay? They have been fighting that 1 hour. Eventually, the hour lapses when all of them are here, and then the candle closes. Okay? So this is our high. The highest price the market has moved during that 1 hour. That is our high price. Okay? Then this is our closing. Okay? And our closing can be 1.2100. 2100. Okay? So this here, between the closing and the open, we call this the body of the candlestick. This is the body of the candlestick between the opening and the closing price. Okay? So this is our low. Okay? This is our low. The lowest the market moved during that 1 hour. So between the open and the low, we call this one a wick. You know, like that wick, a candle. When you burn a candle, there's something which burns. That is the wick. We call it a wick or a tail. All right. Then also the upper one between the close and the high, we also call it a wick or a tail. All right. So you get it? So the market opened at 1.2000. When this hour was starting, see, USD/CAD was at 1.2000. So that is our opening price for this, the last 1 hour. All right. So the bears try to move the market down. They come, they reach there. The bulls take over. They reverse the market. They take it up to the highest point possible. The bears, because we said the forex market, it's a fight between the bulls and the bears. So the numbers take the day. Yeah. If the bulls outweigh the bears, the market will move upwards. If the bears outweigh the bulls, it moves down. All right. So this is the upper wick, the lower wick, and then between the close and the open, that is the body of the candlestick. This is a bullish candlestick because the close, it opened here and it closed here. When the closing is above the opening, that is above. Remember, the bulls, they push it up. So that's a bullish candlestick. A bearish candlestick is the opposite. The only thing to change is the opening and the closing. I can also demonstrate here before we cover the bearish candlestick. So for the bearish candlestick, in this last 1 hour, the market will open around here. Okay, that is our open. We can use the same price, 1.2000. This is our USD/CAD. Starting, it opened at 1.2000. Then the bulls try to fight it. They take it up. Yeah, it reaches here. The bear says no. They muscle themselves up. They start pushing the market down again. They move it down, down up to around here. The bulls try to fight again. They return it. When they're around here, 1 hour, and we say because 1 hour candlestick, the moment that 1 hour lapses, the candlestick just closes. So in this, for this particular one, it will close that at this level. Okay. So when the close is below the open, it means the market in that 1 hour, the force was the bears outweighed the bulls, and that's a bearish candlestick. Okay, so this will be our body of the candlestick between the open and the close, and then the low will remain the low. It will not change. It is the lowest price the market reached during that 1 hour. Low remains the low and the high remains the high. It doesn't change. The only thing which has changed is the open and the close. They have interchanged because here the bears carried the day, right? Everything else, the wick remains. These are still the wicks, but as we go further, we realize the size of the wick matters in our analysis. There are some candlesticks without a wick which also communicate something to you. Some with longer wicks also communicate something to you, and you're going to see what do those wicks, how can we interpret the length of a wick of a candlestick? Whether it is below here or up there, it matters. It gives us some signal about the strength of either the bulls or the bears, or we call it rejection. The bulls rejecting the price or the bears rejecting the price, right? So that's it with that kind of interpretation. We go back to our presentation. Okay, so we've just seen that when the opening price is below the closing price, or rather it closes above the opening price, that's a bullish candlestick. So, but the reverse happens. Yeah, the market closes below the opening during that 1 hour, that's a bearish candlestick. And many times we represent, green will be used to represent bullish candlesticks, and red will be used to represent bearish candlestick. At this level, I want us to take you to the MT4 platform. We look at all these things. And some of the terms we studied yesterday, I also want to show you how you look for them in the MT4 platform. So give me 1 second as I share my screen with you so that you can see this. I'm waiting for it to pop up. I can see on my phone is not yet there, which means maybe the guys using their phones, they can also not see it. There you go. So I think I mentioned to you, you need to download your MT4 platforms. And once you do that, or if you've done that, that is what you can actually see, all right? I've tried to enlarge it so that you can actually see very clearly. And as you can see, we have red and green candlesticks. The green ones means the bulls, that was a bullish candlestick, and the red ones are bearish candlesticks. Like when you look at the first one, the first green candle there, right? You can see when it opened, the wick is so small, it's almost negligible, all right? But if you place your cursor, if it is a bullish candlestick, you place your cursor on the closing, the upper price. Always, if you want to analyze a candlestick, place your cursor at the closing price. So for the bullish candlestick, you place it at the top where the candle closed. Bearish candlestick, you place at the bottom because the closing was below the opening. You place it below there where it closed. It gives you the analysis of that candlestick. Okay, like the green one. When I place my cursor there, this candlestick was formed at 1 p.m. right? And it opened at price. This is so the pair is Euro USD 1 hour time frame. So these are 1 hour candlesticks. They took 1 hour to be formed. Each of these candlesticks, 1 hour it forms once it's the 1 hour axis, that one stops, another one starts forming. Okay, so the first green candle on our chart, it was formed at 1 p.m. All right, and the opening price was 1.13039. The pair is Euro USD. Time frame 1 hour or 8-1. Okay, so it opened at 1.13039. The opening price is here. That it is likely bears tried to fight, and they only moved it by 4 pips to 1.13035. Then the bulls took over. They moved it up to the highest was 1.13214. Then the bears was, no, this is our area. We are going to come in and fight this battle. So you can see the wick is so long, yeah? The upper wick is quite long, meaning the bears were really fighting. And when it is so long, no wonder after it closed, all the other candles are bearish candlesticks. Because of that wick, it tells us the price was rejected. The bears rejected the price and they took over. This is, we call it a supply zone, You can also see on the last candlestick, which is forming right now, which is almost at the same level with the first green candle. Rejection is taking place. The wick is growing and growing. And actually, we discussed about support and resistance. Already, we can already see there's a resistance there. There's resistance. The bulls are unable to penetrate and go up and up. When the price reaches there, it is beat down again because there's some resistance there. Okay, but again, we're also going to details about support and resistance at a future class, at another class. This is to show you about the candlesticks. Again, back to the first green one we've seen, and the volume is 4012. Okay, but that's really, we don't look at the volume so much. Let's look at the opening price, closing price, the highest of that's candlestick, and the lowest, just to demonstrate what we've just covered. Then the second candle is a bearish candlestick. It opened at 1.1313. It opened at 1.1313. Bulls tried to move up. They only moved up to 13. Actually, they moved by pipettes. Remember, we said a pip is the 4th decimal point. The 4th decimal point. But I'm sure when you look at the prices, you see like they are 5 decimal, because you can see like the opening was 1.13134. But the 4 is pipette. We really don't count it at all. We don't count it. It's a pipette. So we only count up to the 4th decimal point. All right? So in this case, the opening and the high were almost, it's 1313. Yeah, and maybe a difference of like 3 pipettes, which don't really make sense. So the tail is so small up there. Then it moved down to 1.1303. That is the lowest price during 1 hour. Okay. Then it moved up again. It closed us 1.1312. Also here there is rejection. You can see here there is a lot of fight, right? Around here. Sorry. There's a lot of fight here, Yes, you can see also the first candle the bears rejected, the second one the bulls also rejected. There's a lot of fight here. So the moment this the longest bearish candlestick, when it closed outside the box, because now the bears were now a little bit in control and they moved the market further. Okay, so you have to be able to draw that kind of zone. The best today is about to draw a zone and be able to tell when the bears or the bulls are winning the battle. Again, but at this time you don't have to worry so much about this. We'll do further analysis. How to remove this box? It's refusing. Anyway, just ignore it. So that's it about the candlesticks, the bearish and the bullish candlesticks. So that's it about the bullish candlesticks and the bearish candlesticks. You've seen the wicks, but those long wicks, they tell us something. And in future, we're going to see what they tell us. Now, when we are still here, I want to illustrate to you some of the things we discussed yesterday, right? Again, this is my demo account. In a demo account, you can always do everything. Please practice there. After this class, you need to go back there, try to identify all these things by yourself and see how you can learn from that. So the first thing I want to show you is about the market execution. Can you hear me? Right now, I can't see you. Just somebody confirm if you can hear me. One person. There's also information about the candlestick at the bottom left. Bottom left. Bottom left. One is that, I'm not sure if I'm getting you, Luther. Default. Bottom left, bottom left. Sorry, Luther, I'm not sure if I'm getting you. You see, there's information about the candlestick at the bottom left. At the bottom left. Is it when I highlight it, Luther? Or what do you mean by bottom left? Luther, kindly clarify so that we get your point or your. There is also information about the candlestick at the bottom left. Is it the bottom of the candlestick or the bottom of my screen? Or if you can just mention what kind of information, I can be able to see if I get what you're saying. At the default section. The default section, when you highlight it. So when I highlight it, let me see, this is when you highlight bottom of the screen. Let me see. Sorry, I'm not sure I'm getting, but I can maybe give you a call later on WhatsApp. I'm not sure if I'm getting. Maybe it's additional information we are trying to. I know you've been doing this. Maybe some additional information can be very helpful if you also try to help us get it. But I'm not. Even I highlight it, I can't see any default. Bottom of the screen. But my bottom, I'm only seeing the bottom of the screen. Oh, yeah. I get what you're saying. Sorry. Yeah. The very bottom. Although that information, it's yeah. Let me show you. Let me see. So when I click like this, you're very right. You are right, Luther. Actually, I didn't know about that. I've also learned something from you. So what Luther is saying, when I like this, that candlestick, when you check at the bottom, what is for help, press F1. On that line, you see the word default, okay? You also get that particular information there, right? Which says the date, the time, (21) 12:10. Yeah. You're very right. So when you click on any of those candlesticks, at the very bottom, where you can see for help, press F1. You see also along that line, there is the word default on that line. So when you press your cursor, it tells you the time of that candlestick, and the opening price, the highest of that candlestick, the lowest, and the closing. That is very true, Luther. Thank you. I get you. That is very true. Great. So any other question or concern or clarification? Any other? So thank you, Luca. I get what you're saying. You get it now. At the default, at the very bottom. Great. So now we want to go further and see some of the things we discussed yesterday. We want to demonstrate them. And one of them was about market execution, placing orders. How do you place your orders? All right. And we said you come to new order. At the top bars, oh, there are so many things up there. With time, I'll tell you what all those means. You learn with time. We're not able to explain everything today, but with the time as you practice, you learn what icon stands for. Yeah. For now, we are going to the new order to see how to place orders. When you click the new order, as we said yesterday, I need to go back to my presentation to see what you're seeing. Yeah. When you go to new order, this screen or the dialog box comes, and it has a lot of information. The first line, it has simple. That tells you it gives you the currency pair you're about to trade, or rather you're about to open a trade for. The second one is the volume, right? The volume means the number of lots. Remember, we said there is the standard lot, which can be one, which is given to $100,000. There can also be, so when you click on the drop-down box, it populates for you. Yeah, you can select what you want to enter. Per trade, most of them, they set a maximum of 30 lots. Yeah, that's the maximum you can enter a trade. And the minimum is 0.01. That's a micro lot. Okay, but you can always change. Okay, you cannot see 0.1. You cannot see 0.2. So you can always change. When you write it, you just type 0.1. If you want a mini lot, right? Or 0.7. You can put anything between 0.01 to 30. Minimum being 0.001, that is a micro lot, and the maximum being 30 lots, right? So the volume, it means the number of lots you want to trade, or the number of contracts. Okay, then below that we have the stop loss. Remember, we said after you do your analysis, you decide, based on my analysis in this trade, I'm only willing to lose this amount of dollars, whether $20 or $40. So based on your analysis, you set up the stop loss. Okay. On the same line with stop loss, you have the take profit, which again said you set up. This is the amount of profit I want to make from this. Based on my analysis, the price is likely to move up to this level. Then after that, I want to take my profit at that price. Right? So that is that's why you set your take profit. Comment, nothing much. I don't think I've never used it myself. Maybe there's a comment you can write for yourself, but I've never really used it. Then we have the type. And the first one, by default, is always market execution. Right? And we saw what market execution is all about. And we said market execution, you trade when you buy or you sell. You buy and sell at the prevailing market price. The price displayed on the screen. Right now, as we speak, we can see under the sell, which is our bid price, it's 1.13. It's really moving. You can see just flicking and flicking all the time. It's just moving and moving. It's not constant. Because right now, again, the actually London session has just closed 7 minutes ago. That's 8 p.m. Indian time. Right now, we have the New York session. But the two are pretty busy. They're equally busy. Anytime from 4 p.m., you can actually trade comfortably because there's the overlap of the London session and the New York session. And also the New York session will continue being active until around 9 or 10. So as it approaches the closing time, it starts like going down, then maybe the last few minutes before the market closes. Okay. Also during the New York, the American lunch time, if you go to know their lunch time, the liquid also goes very down. The market can just slow down like it's actually dead. Those guys, I think they take their lunch very seriously. Yeah? They close and go for lunch. Okay, so there are moments just during the New York session, the market just like very calm, not moving, and you're like, I thought it's the New York session. But because during the lunch hour, the volumes go down, right? So right now we're saying our bid price is 1.1316, yeah? And the asking price is 1.1316. So if I am to sell right now, my order will be filled at 1.1315. And if I am to buy, you can see the buy side, buy by market, meaning you buy by market execution or at the current market price, right? So that is what it means. If you want to sell, you click the one, you can sell by market, and it fills that bid price. You want to buy, you go to the blue side, which is read by buy by market, and your order is filled by the asking price. Something else, when you look at those two prices, the bid price and the asking price, although they are moving so much, you can always look at keenly. Like right now, you can see is 13.15. The other one is also 13.15. Right? There are moments the 4 digits is the same. Okay, 13.15, 13.15. Remember, we said spread is the difference between the bid price and the asking price. So, like this particular, let me just type and see if it's gonna share a number again shortly. 15.4, 16.0. When I focus on that one, it stops moving and stops changing. Anyway, but this tells you the spread in this pair is negligible. It is less, like 13, 16.4, that is 16.9. Okay? So you can see the fourth decimal point is the same. 13.16, 13.16. Can you see that? So that tells you the spread is negligible. It's pipettes. It's 0 something of a pip. And we said, when you're looking for a broker, look for the broker with the smallest spreads. As I mentioned to you, FX team is one of the good brokers. That's why I was actually recommending it to you, but you can always select a different one. But that's some of the things you check when you're selecting a broker. That is the difference in spread, because we say spreads can make you or break you. When they are so huge, you lose so much money. Okay? When they are so small, it means they work in your favor. Like in this case, the spread is negligible. It's in pipettes, 0 point something of a pip. All right. So now we want to enter a transaction. I want to go back to trade. I want to edit my account so I can sell without any analysis. So if we do our analysis and we decide we are going to buy, like here, let's assume this is our resistance, although it seems to be breaking. But anyway, no analysis. We just want to enter a trade to see how it works. So we are going to, we click sell at as behavior. We bought a 0.7 over lot. That is 7 mini lots. 0.7 means 7 mini lots. Okay. So after we enter that, we didn't enter the stop loss, but we're going to modify that. So when you look at the blue line, which is modified, you can see all the information there. We have the time you entered the trade, the type is a sell, the size, that is the volume, is 0.7 over lot. Then the symbol, the currency here is Euro USD. We enter that particular price. Currently, our stop loss is 0, TP is 0, and this price is the current prevailing price. Then there is always a combination. There is a which is based on the number of lots. I think it's usually $7 per lot, or something like. Although it depends on each pair. For dollar, it's like 0 point something. But anyway, all brokers have commissions, so you don't have to be worried of that. It's always not so much. If you select a smaller value, the commissions will become smaller. So once you enter and you want to modify to put your stop loss or your take profit, actually you can also do that before you enter the trade. But now you've already entered. You highlight, then you right click it. When you right click, you see that screen comes. You go to modify or delete order. So you click on modify. It brings you this screen for you to modify. So we are saying we want to enter our stop loss and our take profit. This, remember, we sold there. So if it's a sell, your stop loss must be above that price because you expect the market to move down, right? But you're saying just in case the market does not move down, it moves up against me, I'm only willing to lose this amount of dollars. So we can say 1.1330. Okay, and then the profit, it has to be below our buying price, which is 1.1330. 13, not 13, but sure, yeah, 1300. Okay. Then once you key what you want to modify, there's that red bar written modify hash this order, the details of the transaction. Then you click on the red bar, right? And now you can see it has, now we have an SL as stop loss and we have a take profit. All right, can you see that we have SL, now we have 1.1300 and a take profit 1.1300. All right, or at 1300, without counting the pipettes. But you can always modify. We said when you see the market is moving in your favor, all right, I try to minimize to see my lines properly. So our take profit is down here, the red line below our entry. So you see the market is moving so fast, you can always adjust your take profit. You drag it down further. You drag it down, okay, to give it room to earn you more profits, all right? And if the price moves down to around somewhere here, you can always, move your stop loss to a trailing stop. Right now it will not allow us because we are not yet in profit, so it will not move, all right? So we cannot move it, it will stay there until we go into profit. So when we feel it has moved good enough for us to lock profits, then at that level we move our stop loss to lock our profits, then we can trade. Actually, that entry is pretty good. That entry is pretty good because it's at an area of resistance. So by all means, and our stop loss, although we did not really do an analysis, it's above what we call structure. So by all means, unless something has happened, I don't expect this market to move up. It has been bearish market, should continue moving down. But again, we said in the Forex, there are no guarantees, it can always work against you. So that's why we have a stop loss. But when looking at a chart like this, it's a very good entry, sell entry. We then should be able to move into profit. All right? So you've seen how we entered, that's a market execution. We just open the new order. You see the type is market execution. You decide whether to buy or to sell, then you just click it and it fills at the prevailing market price. Okay? That's our market execution. Again, we said you can set up a trailing order. You're already in profit and you're telling the market to trail your entry at maybe 20 points or 50 points away from the current market price. So you come to your order. So when it's highlighted, right click it, go to trailing stop. All right. Once you right click, you have the trailing stop. When you place your cursor on trailing stop, it populates the number of points you want to trail it. All right. These points, like if you click 50 points, that actually means 5 pips. You see it's already highlighted. It will be hit anytime, right? The moment you put the trailing stop, the SL changes to the trailing stop. But because you're not in profit, it has actually refused. It is remained at where it was, wherever we placed it at initially, because we are not yet in profit. All right? But once you're already in profit, you can change your SL to trailing stop, and then it starts to trail. As the market moves, the trailing stop, it follows it, and it continues locking more profit in you. Right? So when you're in profit, you can move that, change SL to trailing stop, and it continues to trade the market. But again, we said if you're trailing automatically, you have to ensure everything is on. Your system is on, your laptop is on, and all the systems are online. Otherwise, if it goes off, the screen is off, the machine is offline, you're not online, the trailing stop will just stop and stop trailing. Just stop like a sell stop at one point. And then at that level, it doesn't move in the direction. It will wait for the price to come and hit it, and then the trade is closed. But after all, your profit is already locked. You're already in profit. Great. So that is market execution. I want us to look at the pending orders. All right. We discussed about pending orders yesterday. So you go to the same place, new order. The screen comes. Okay. That screen comes. Where we have type market execution, there is an arrow, a drop down. You click on it. So we have two options, either market execution or a pending order. So now we want to place a pending order. So we click on pending order. When you click on it, it gives you 5 options to select the kind of pending order you want to place, right? And we have under the type, there is a drop down. You click on it, it gives you the 4 options we discussed. That's a buy limit, a sell limit, a buy stop, or a sell stop. Okay? So, because our market you're saying is a bearish market, we want a sell stop. Anyone can remember what you said a sell stop is? In your own words. Anyone who can type in for us? What's a sell stop? Well, I know it was a lot of words. Maybe at your own time you can place it. I will give an assignment. You place one and you send a screen to us. Then we'll know whether it's a sell stop or it is what kind of a stop. That's to be our assignment. Maybe not today. But start practice. You never know when it will happen. Please start practicing. So if we want to sell a sell stop, we say for a sell stop, it means the market has been moving up and up. And we see the market about to reverse. So we are saying, once this market reverses, I'll only be sure it is a bearish market if it crosses a certain line. And that line is defined by a certain price. Okay? So we put our pending order there such that when the market crosses, it fills our order. And then now the trade is activated. All right. So we can say the market price is at we can always check here. This is 1319. So we are saying once the market goes to 1310, okay, that's 100. That's the only time we'll be sure the market it's a bearish market. So once you set up your price for sell stop, you click on place. All right, you click on place. You see, it's already highlighted in green. Anytime there's a difference of less than 10 pips, it gives you a signal to tell you your order is almost, now you can see my sell stop is now in red. It gives you a signal. You are like to be hit either as profit or your order is like it's almost being filled. As long as it's less than 10 pips, it will give you an highlight. You can see both of them because they have a difference of 10 from the current market price. When it moves up, the signal gets highlighted. It moves down, my pending order gets highlighted. It tells me I'm less than 10 pips away to be filled. When you see it highlighting in green, the pending order. All right? So that's our sell stop. So you can also go back and you can place any pending order you want to, depending on your analysis. All right? You come to drop down, select pending order, then you select whichever you want. Is it a sell limit? You're saying the market has to go up. So when you go up, pick my order and fill. That's a sell limit. It is being filled with the highest price possible. So that when the market moves down, it fills it at a profit, at a good profit. That is because it fills the best price possible. All right? Great. My screen here, let me enlarge it again for you to see. This screen, you can always change it to whatever you want. Right now, my background is white. I've removed those crosses. You can see very different from this other screen here. It's going to populate this one here. So this one, I just put like that to be able to teach you. But depending on your favorite colors, so you can always change to what you want. So you place your cursor anywhere on the screen, on the chart. You right click, then you go to properties. Okay, right. Is there a question? I'm seeing there's a comment. About the volume. The volume, we really don't look at it. Myself, I don't focus on the volume so much. I mostly look at just the closing price. At the size of the candle, it matters, and we look at that later. We look at that. For now, you're focusing on the opening price, the closing price, the low. But later we look at the volume. That's the size of the candlestick. We look at that. Also, mostly I don't look so much at the volume. But it's good to do. We'll still mention it, but may not be a key point for me when it comes to analysis. But we'll mention it as we get deeper into real analysis. Right? Hope I answered your question. Or you have something more about it you'd like to mention? All right. So for now, we're looking at the volume, which is mostly the size of the body of the candlestick. All right. So we're not bother so much. We're just focusing on the opening price, the closing price, the high and the low. But as we go into details and analysis, now we can check deeper into the size. But sometimes really the volume it's more. It can be like a market excitement. Many times I really don't focus, but we'll see how we can incorporate that if actually it's really important. But we'll look at it later. Sorry. So we go back to if you want to change how your screen looks like. You just place your cursor anywhere on your price chart. You right click, you go down to properties, okay? Then you click on properties. It brings you that screen where you can change whatever you want to change, even if the background. Mine is white. You can click on it and you change to anything. You want it to be black, you make it black. That's how it's gonna look like if it's black. You want it to look like something else, like maybe you have yellow, you make it look yellow, right? So that's where you change how the screen looks like, all right? But mine I retain it at white as it is. Then the grids. The grid are the crossings. Some people prefer with grids, yeah? So you can always put the grids. The foreground. It means now all what information which is being displayed. The cell stop and all that. You can put the color you want, right? Mine was everything was white, but now you can actually see when we put foreground as black. It shows the details of the entry you have entered. That actually we can just leave like that. We saw that volume of 0.7. That's where our cell stop is. That's where our TP is. So we go back to properties and see what else can we change. The grid. Grid means the lines in between your chart. Mine was none. You can always put. You want it to be black, you put. That's how the grids will make your chart look like. You know, those crossings. If you want to have it, you can always put. Sometimes if it's necessary, so it depends on your preferences, how you want your chart to look like. Okay? For now, again, I will leave it none for ease of our analysis. Then we have the bar up. That means the lining on the bar which is going up, the lining on our bullish candlesticks. For now, I put the same color with the body of the candlestick, which is the line. But you can always change. You can say, I want to align it with black. And that's how it will look like, with the black lining on the outside, okay? That's how it looks like, the black lining on the outside, okay? You can also say, actually the bulls look over, they crossed our region of resistance. They are going up. We are almost being knocked out, but it's fine. This is our testing entries, so no problem. Not worried. It's a demo account after all. And then we are saying the bar going down. All right. Currently, I retained the lining of the bullish, bearish candlestick with the same color as the body of the candlestick, as red. But again, you can always change. You can beautify it. The best way you feel it is going to make your trading good, or rather enjoy looking at the charts. You can always change and put whatever you want. And the bull candlestick, the bull candles, the bullish candles, we had put green. You can always change to whatever you want. For yellow, go for it. Yeah, you prefer pink. That is tomato pink. Anyway, tomato color, sorry. So let me just return them to how they were. But I just wanted to show you, you can always change to what you're comfortable with, colors you want. And I just want to show you how to change these colors, okay? Right, so we go back to where we were. So this is where you're able to change everything. Just right click, go to properties, and all this populates. Then we cancel. Another thing, you can see on the bar here, I have my I have the gold, euro, S5, this is what I call the indices. Myself, I like the indices. Yeah. For now, we're not going to, but later you know how to do it. After you do that, you can actually decide. But the indices move. These ones move by large volumes. That's why as you start, stay away from indices. They can make you money in an instant. They can also wipe your account in an instant because indices move. This is the S&P 500 and the Wall Street 30. They also do a lot of gapping, so those ones, just ignore them. So I wanted to show how do you bring the pairs here for you to do analysis, right? At the left of the screen, there's something written Market Watch. Market Watch, okay, where you can see my cursor is. That is a Market Watch, all right? So all the pairs are there. The majors, the exotic, everything, all of them are listed there, yeah? So if you want to bring a pair from here to your screen analysis, you select one you want to bring here, right? Like in this case, I can select pick what we've been discussing, the USD CAD. Yeah? That's been one we've been quoting mostly. So you just select it by highlighting in blue. Then you right click and then you say Start Window, right? Did you see that? I can close it to take you back again. So you just highlight it like this in blue. You right click. That list comes and you say chart. So it comes to the chart for you to be able to do analysis. All right. But when it comes, like this particular one, it is a bar chart by default. It's not a candlestick. So again, the same line where we're picking the new order. As you move towards the right, there's some auto trading, then there are those symbols. The first one is the bar chart. The second one is the candlesticks. You click on it to change your chart to a bar stick. And then you go to the magnifying glass, which is a plus to zoom in. So you click on it to make the candles wide enough for you to be able to trade, just the way you want it to be. All right. So that's how you bring a pair from the Market Watch to your screen for your analysis, right? The other thing, maybe there's a pair you want to trade because not all the pairs will appear on the Market Watch. If you want a pair to appear on the Market Watch and it's not appearing, there's somewhere written File. You can see where my cursor is. There's File, View, Insert, Charts, Tools, all that. So you click on View. When you click on View, you go to Symbols. You click on Symbols, right? So a pair which you want it to appear and is not appearing, like in my case, I don't have USDZR. That is the dollar versus South African rand. All right. Just highlight and you say show. Okay. The moment you say show and you close, it will come to your Market Watch, and it's at the very bottom. Okay. That is the USD. That is the dollar versus the South African rand. So you can always right click on it, then click on Market Watch. Sorry, chart window for it to come for my analysis. All right. Then again, I got the same procedure. This is a bar chart. I want to be candlesticks. I click on the candlestick to highlight it. Then I magnify it to make them visible clearly for my analysis. All right. Good. I think for some of the things we covered yesterday, I wanted to show you. Again, we talked about candlesticks. Let's go back to our clear one. We talked about the time frames, and we said we have 1 minute candlestick. All these time frames are here. If you want to analyze, you click the time you're comfortable with. Which size of candlesticks are you comfortable with? Is it 1 minute? You click on 1 minute, you do your analysis. Okay, you can see how they are moving. It's a 1 minute candlestick. To mean every 1 minute, a candlestick is forming. We can actually check the one which is forming right now. It's a bullish candlestick moving up and down. Both the bears are fighting. Let's see at the end of this 1 minute, we see what is going to happen. Because it's a 1 minute candlestick. At the end of 1 minute, that candlestick will close at that particular price, and another one will start forming, right? Will start. You've seen that? 1 minute is over, another candle started forming. So that is the 1 minute candlestick. Every 1 minute, and now this one is a bearish, or rather, bearish candlestick. This is already moving down. But again, until it closes, you can never know what it's going to be. Because even those last 5 seconds, it can actually, the bulls can take over and push it up again. And it closes as a bullish candlestick. So even in your analysis, before you make a decision, you only wait for a candlestick to close to confirm your decision. And we call them rotation candles. We'll see all that when you're doing your analysis, but you can only confirm whether the candlestick is bearish or bullish after it closes. Before then, anything can still happen. Anything is possible, all right? So that one is for me. We're going to watch and see whether it's going to close as a bearish candlestick or a bullish candlestick. It has closed as a bearish candlestick, okay? So that's how the candlestick is a 1 minute candlestick. So then we have the 5 minute candlestick. So mean every 5 minutes, when a candle 5 minutes lapses, that candle closes, another one starts forming. Again, we say the closing price for the previous candlestick is the opening price for the next candlestick. Like I'm highlighting, it was closed at 1.13053. So the second one, it opened at 1.13053. So it should always, that should always be the case, unless we have gapping. Yeah, and we saw gapping is where the market opens at a different price, either higher or lower than the previous closing price of the previous candlestick. All right. Unless there is gapping, which is also rare, we'll also discuss when to expect gappings. So always the opening price should be the same as the closing. Like now, the last candle just closed. Another one is because 5 minutes have just elapsed. It's now 8:35, right? So that's how the 5 minute candlesticks they do form. Then we have 15 minutes. So some people will ask you, your analysis is based on what time frame, right? So you choose the time frame you're comfortable with. Some are okay with 15 minutes, others 4 hours, okay? So like personally, because I spend a lot of time on the screen, I use the lower time frames. Mostly the 5 from 1, I use 1 minute to make my decision to enter. But for analysis, I must use the 5 minutes, but I always go to 15, M30, and H1. The longer time frames, it gives me the long-term direction of the market, because it's very important to know in the long term, where is the market directed to? Is it a bearish market? Is it a bullish market? And if the small time frames, the candles are aligned in the same direction with the bigger time frames, then if you get your analysis right, you're likely to have a possibility or probability of making a profit there higher when the shorter time frames are aligned with the long-term time frames. And then you also see all that and see how that also works. So those are the time frames. You have the 4 hour, which is we call the H4. D1 is the daily candlestick. This means this candlestick, it took the whole day to be formed. All right. Like today's daily candlestick is a bullish candlestick. But you can see the market has been bearish all these days. The first red one was on 4th of February. I think we had the first bearish candlestick for the daily candlesticks. And the price was 1.14500. So the market has really moved by 100 pips. But you see, you cannot look at the price today. Today is at 13.19, and that it was actually 14.50. You cannot see in all those days the market just moved by 100 points. In the same way the market moves up and down, up in one day, although the market have moved by 100 points, you can actually make a trade of 200 points. Sometimes in our analysis, you're able to enter trade, make your profits, the market reverses, you enter again, hit your profit, you exit, the market, it keeps on giving you many opportunities. Like if you're a full-time trader, you can enter at least 5 trades in a day. And each trade you make your money, it closes, you close your trade, you wait for the market to give you another opportunity to re-enter. Yeah, because that will also eliminate the chance of losing more profits as the market retraces. Okay. So the market, maybe it has moved by 200 points in 2 days, but in essence, you can actually make profit of almost 300 points in those 2 days because of entering and because the market moves and it retraces. So when it goes, hits your profit, it retraces, and you can see it's still bullish, you re-enter as many times as you're able to do that. Okay. That is the daily candlesticks. We have the weekly candlesticks. You can see like this week, it almost looks like a cross, a stick. A stick. And that means a lot. That means a lot. Today is Tuesday. No, it's still early. Still early to know how the market's going to close. But you can see already the market is at a very strong support when it comes to weekly candlesticks. The market has been unable to cross that zone. Yeah, you can see here there's a very strong support in this region. We are highlighted in yellow. Yellow cannot be seen. Well, I think you can still see it. Then you can see the market, the bears are unable to penetrate through. They are unable to close below that region. So that you can already see in our weekly chart, there's a very strong support. That's why we even say, even if you're a short-term time frame trader, once in a while check the long term, they can actually tell you where the market is going next. Because if today was a Friday and we have this end of a weekly candlestick, it would actually tell us the bulls are taking over. The price has been rejected out here and the bulls are taking over. And we expect the forex to be most likely to be a bullish market. So even your time, or rather your small time frame candles give you a signal of a bullish candlestick, you can actually enter and hold your trade for some time because the market already in the long time frame, it shows it's going to be a bullish market, right? And again, we are going to get into details about this analysis. Remember, we said your trade can always, where I place my stop loss, if you remember, at some point, my loss was around $40, yeah? But I was just relaxed. You can see it has now gone down to $9 loss. I do still let it run. When you've done your, this we did do an analysis, but I just looked at after we entered, when I looked at the structure of the market, maybe feel there's some resistance here. All right, so you're like, let's see how it can still go to a loss, can go anywhere, but when you've done your analysis, let the market be. But sometimes like you're almost being hit, then it reverses. Then I remember I missed, my stop loss was met with pipettes. And when it reversed, I made a lot of profit. So never be worried. Don't even move that stop loss. If it's hidden, don't worry. You've done your analysis, let the market play its games. All right? Great. So I think that's enough demonstration. Unless there's something else you want to see in this platform, anything you want me to show in the platform, you can tell me. Otherwise, I think I'll try to illustrate most of the things we did yesterday as much as possible. We'll get into details of all these symbols and the icons on the chart once we get into deeper into analysis. Any question regarding the platform? Any clarification? Anything you want to know what it is used for on the platform before we move? Well, maybe you've not even yet interacted with the platform, but from now you can start getting to your MT4 platform, try to analyze, enter your trades, sell, buy. Don't worry if you make a loss. Don't worry if that account is wiped out. It's a demo account. If it is in zero, you go back to my FXTM, you deposit more money. It's a demo account. So in FX, you don't even have to call them to add your money. No. Log into my FXTM, load more money to your demo, trade and practice Right now, just enter to test them. You don't even have to do an analysis right now. It is trying to see how do I enter my entries, pending order, market execution. Where do I place my stop? Just try to see how do I do all this without even caring where the market is going. If you must care, well and good. But for right now, we've not yet done an analysis. It's just to try to practice how to enter your entries. Then with time now, when you start doing analysis, you'll be able to begin to practice what we've studied in our analysis. All right. So to all types, go to your platforms and practice all this. When you're stuck, please ask questions. You don't have to wait during the class time. Send a WhatsApp either in the group, but I would prefer you can send on the group so that maybe somebody else asks the same question. They also get answered as we answer the rest of us, right? So any query, any concern, please just ask on the group, then you're able to discuss. It can also help another person understand the issue you have faced, right? Great. So now we go back to the presentation. I want to end screen sharing. We go back to our presentation. Those the comments. Great. Carol, you rejoined us. Good. By the way, if you can join as many classes as possible, it will be good. Good, good. Join as many as you can. If you can join at 10 and at 7 p.m., very good. I want guys to spend more time and learn and ask questions. Maybe you missed something on this class, during the following class, and you're able to also to get deep understanding. Glad to see you, Carol. So now the next thing is about our technical analysis and patterns, right? But again, I don't want to go into details with this before you interact, because now here we are going to look at the patterns the candlesticks forms, all right? But before we go here, please take your time, even if it's just 30 minutes, go to your chart either tonight or tomorrow morning, and in the course of the day tomorrow before the next class. Try to see, identify those candlesticks on your screen. See those market opening price, closing price, the wick. If there are any questions arising, please ask. Look at them. Then now tomorrow we look at the technical analysis and the patterns. Yeah, when you've already interacted with them. Because if we just continue with so much information and before you internalize, it just be lost. Yeah. So now tomorrow we're going to do about the trends and the patterns the candlesticks forms. Any question? I really hope there's a question today. Please ask a question today. Any question? Any question? If there's no question, I'll be shocked. You guys just absorb everything and you digest and no question. It just sinks. It also means maybe there is nothing which is thinking. Which is which? Kindly ask questions. Any question regarding today's class or the yesterday's class or anything about the forex market you want us to clarify in this class? We still have some minutes. Whoever is typing, so waiting. That's the best time frame to trade. Which is the best time frame? You said that's the best time frame to trade. Amma, you're asking what is the best time to trade? Luther, I'm not sure. You are saying that's the best time frame to trade. Which one? What? That one depends on the time you have, right? Like someone who is working, 15 minutes may not really be very okay for you. Yeah, unless you have dedicated like 2 hours, you can be on the screen without any interruption. All right. But with time, actually, there is no particular good time frame. Any time frame is okay. 1 minute is okay. It depends on the time you have. All right. Do you have enough time to spend on the screen? Maybe how much of the screen time do you have? The longer time frame screen time you have, then you can use less time frames. But it also depends. Yeah, it depends. For now, we cannot say which is the best. But as we go into analysis, everybody will identify which is my best time to trade. Okay, you could be able to get it. For now, we cannot say that this is the best or that is the best. But as we go deeper, yourself, based on the time you have available and your environment, you're able to tell. I can actually spend, or rather the 1 hour or 4 hour or even a day one is the best for me to trade. Yes, for a bullish candlestick, when is the best time to trade? At open or close? Okay, very good question, Carol. But again, the candlestick itself, it cannot tell us when to enter. It can never tell us. But once you've done your analysis, and there's what we call rotation candle, a rotation candlestick. A rotation candlestick that gives us a signal. And you're going to see, we are going to analyze and say, when do I expect this candlestick? Okay? And once it forms, or rather, let's call it a signal candlestick, but because it can take any shape. A signal candlestick, you have to wait for it to close, whether it is bullish or bearish. So the signal candlestick gives you the signal to enter the market. If you see, like we said, when we look at the weekly candlestick, it was already forming a very long wick at the bottom. It was forming what we call it a kangaroo tail. You are not yet there. Kangaroo tail. But some guys here maybe understand. Some people here, they know what a kangaroo tail is. They have been to some of these, they have learned some of these things. So when you see such a candlestick forming, that's a signal candlestick. So that's why I would say if today was a Friday and I see such a weekly candle, I'll be so keen to know how the market will open on Monday, because I will be looking for longs. I'll be looking for opportunity to buy. So when you see a signal candlestick, then now you wait for a signal candlestick to close, then you enter as the second candlestick starts, all right? But for now, we cannot tell whether you enter at the close or at the opening of a bullish candlestick. All in all, when you do your analysis, you get your signal candlestick, it's already forming, wait for your signal candlestick to close. When it closes, now you enter the market with the next candlestick, right? So Carol, for now, that question, we just hold it now until we start identifying the signal candles, which tell you when to enter the market, right? Hope I answered your question. But for now, just hold it. For now, we cannot tell whether to enter at open or close until we do the signal candlesticks, which signifies to you it is time to enter. Or you can also call them the rotation candles. It depends on which one you're using as your signal candlestick, right? What determines the duration of analysis, that if you should review for 5 minutes or 1 week or 1 day? What determines this mostly, it depends on the, as I answered actually, is like the same question what Luther asked. So for you to use the 5 minutes, it depends on the screen time you have. By screen time, I mean how much of time do you have in the course of the day to stay on your screen, right? Somebody like me was more time on the screen, I can use the smaller time frames, 5 minutes, because they are closing, frequently. But somebody who is working, like you and the other guys who are actually working, 5 minutes may not work for you, but can actually work for you if you decide every day between this and this time, that will be my trading time. And I only want to enter trade and close within that period. Like if you dedicate like 2 hours every day and you say every day, now like right now we are doing classes from 7 to 9. You say even after this class, every day from 7 to 9, I'm going to do my analysis. Now, during that time of practicing, you are able to see which candlesticks give me opportunities to enter a trade and close before I go to sleep. Or I'm able to enter a trade and even protect it before I go to sleep. So once you identify your best trading time and the amount of time you have for trading, then you can decide which candlestick works for you. Actually, in those 2 hours, you can even work with a 5-minute candlestick and you're still done for the day. But a week, it's mostly week and the day, it's for long-term traders, okay? Those guys are the ones who enter a trade and let it run for a week. A week and day can be quite, you have to wait for a while to get a pattern, or rather to have your trade even become profitable. So it's for weekend a day is the best for long-term traders. The guys who will enter a trade and just relax, let it run even for a month, are the ones who use the long term. But for us right now in this class, the best between maybe 5 to H4. H4 is 4 hours, all right? But again, you have very short screen time. You may not be able to wait for that 4 hours. So with time, actually, as we start and we analyze, you'll automatically be able to know which is the best time frame I can actually use. But 5 minutes for intraday. If you want to enter the trade today and close today, 5 minutes can be enough. But only if you're able to spend at least 2 hours on your screen. At least 2 hours on your screen, right? You sit down at 7 p.m., look at your screen like this, do your analysis and wait, right? So it depends. But for now, it's still early to really say which is best is not the best. But as we continue, you're going to see what best works for you, right? As we go deeper into analysis, you'll be able to know which is the best time frame as you go into analysis. But 1 week, 1 day may not be applicable for intraday traders like me and you who want to trade today and close or trade today and you don't get out of the market today. For a day or 1 week is those who want to hold their trades for many days or many weeks, just running. Marianne, I answered your question, but for now we cannot tell you the best time to use for your trading. But in our analysis, mostly myself, we'll focus more on the 5 minutes and 15 minutes, that range. We'll draw our patterns on the 5 minutes, especially what we call the Fibonacci's, the structure. We'll focus more on the smaller time frames, yeah? But you'll always find the same strategy applies on the longer time frames, the same strategy you're going to learn on the short-term time frames and always apply on the long-term time frames. Any other question? For trading, it's good to use the computer for trading, because when you use the phone may not really help you to draw some of the parts you're going to draw. The FXCM mobile, it helps you to track the prices. But if actually people can trade using it, you know, you guys, some of you are very advanced in technology. Some people just use it to trade. But I find it tricky to use it for analysis. You may not be able to draw some of these patterns. So you can use it to monitor your trades. But for analyzing, it's good to use a laptop. I would recommend a laptop for analysis. But they had a presentation on how to use the FXCM mobile, the app itself, for trading. But because I don't have any interest, I did not follow. But I can check with them. Actually, also, anytime you have any question about FXCM, anything to do with their platforms and how you use the particular one, always you can actually approach them online on their live chat. They're always quick to respond. And whatever they reply to you, you can check that, you can send that conversation to your email to be able to refer in future, right? But the FXCM mobile app itself to trade only used to track the prices and to set some alerts. You have to alert when the price reaches a certain level. But for trading, I've not tried it. I always imagine to analyze with a phone can be a little bit tricky. But guys, some of you know they're very good in they are high tech. You're good in technology. You can do some of these, some of us you're not able to do. But for analysis, I think the computer would be better off. You can analyze with the computer and then you monitor with your phone, right? But according to FXCM, you can actually trade using the app. It's only that personally, I am not yet there to know how to trade using the app. But if you want more info about that, just go to their live chat and ask them, I have this app, how do I trade? How do I enter my trades using the mobile app, the FXCM mobile app? They'll always be able to guide you in that. Any other question? At least today we have some questions. Tells me we are listening. Rather, we are getting somewhere. Not that you've not been listening. When you ask question, I'm like, now we are together. You're most welcome, Marianne. Okay, guys, so please take your time and look at the screens, interact with them, and anytime you have a question, just ask. In the course of the day, you don't have to wait for the class to start. Drop any question we are going to work through together. So tomorrow we'll start on technical analysis and the patterns. Look at the patterns which the candlestick forms, which now helps us to make decisions to enter or not to enter, to sell on or to buy. Okay, thank you so much for your time. Have a lovely evening. We'll see you tomorrow. Good night. The videos, I'm trying to put them together. I was trying to analyze today actually. Thank you even for bringing that to my attention. Last night I don't know even how I closed, but you will have the videos. I'll start put them together to send them to you, Jack.